Good afternoon. This is Tony Cherniawski, President of the Practical Investor, LLC. Today is October 22nd, 2008. This video is part of a series called Options Madness in Today's Market, Part 2. What I'd like to do is describe the continued acceleration of the market centered around options expiration and the increasing spikes in volatility that we've seen since January of this year. So between August and January of this year, we saw a 22-week respite between severe market declines. We had a 12% decline in August and a 19% decline in January. We had yet another decline, even deeper, in March, and then the market had a rest, you might say, until July of this year. So without further ado, let's look at the July market and talk a little bit about what happened here. Again, we had a severe crisis at options expiration. Options week began on the 14th of July, and you can see the market was already in a very swift decline. What happened is it finally caught itself on the 15th. It made a low, and as a matter of fact, we saw index options mature at about 1250 when indeed the no pain zone was about 1275. So it was on the outer edge of the no pain zone. I believe the market probably suffered something to the tune of $50 to $75 billion in losses. Now, stock options matured on Friday the 21st, and they matured a little bit closer to the no pain zone. So what we saw here was a tremendous amount of volatility. And as a matter of fact, we saw a 7.5% rally in just a matter of 6 days. Now, let's take this the next step, though, because what we need to do is look at September and determine what's going on now. Options week began just a little bit out of the no pain zone, but it decelerated, you might say, or accelerated into its low, which happened to be on Thursday, September the 18th. Options expiration should have matured at 3 o'clock on Thursday. However, a very dramatic rally began at 3 o'clock Thursday afternoon. Normally, we would have seen a potential crash at that time. Instead, the market rallied up to about 1250, or rather 1260, Friday morning. So the options exchange actually changed the rules overnight. So instead of honoring the options that were supposed to have matured at 3 o'clock on Thursday, they instead reset the maturity price to the first hour of the day on Friday. I don't really believe that the people who bet correctly that the market was going down appreciated this very much at all. We saw stock options maturing later on that day in a period or in an area very, very close. But I still believe that over $100 billion of investor money, at least, and possibly much more than that, was not paid due to the change in maturity from 3 o'clock on Thursday to the first hour of market on Friday. I don't know if we're going to be seeing lawsuits on this, but I certainly hope somebody pays attention to what's been going on here. Finally, we want to look at October and take a peek at what's going on this month. We saw options expiration week begin in the middle of a decline. We saw a very abrupt rally up. In fact, let's go back for a moment to August, and I just want to point out something here. This was the first time we saw a 12% rally in one day. This is something that's virtually unheard of. This occurred within about a 24-hour period. It didn't all happen in the same market day, so it wasn't quite recorded as that, but it still happened nonetheless within 24 hours. On Thursday of on options expiration week in October of this year, we saw another 12.5% rally in a single day. This is an amazing feat to behold. We've never seen this before, and yet it smacks, I believe, of market intervention in the middle of options expiration. The whole idea of this game is that the house supposedly never loses. In this case, the losses were massive. The no pain zone is simply off the charts at 1200 you don't even see it on this chart because the top price here is $11.50. So the point that I want to make is that options expirations tend to destabilize the market. We've seen greater and greater declines and rallies. By the way, this 12.5% rally occurred after an 18% decline in 1 week. So we've seen some pretty strong moves in both directions. However, the rally itself speaks of intervention and of attempts to ease the pain of Wall Street. This may be one of the reasons why Merrill Lynch jumped into the hands of Citigroup, because Citigroup has money. Not only do they have ample funds, but they also have the ability to go to the Federal Reserve window and directly to the U.S. Treasury as well. I believe that Merrill Lynch posted roughly a 90% loss of its capital in the second quarter. The losses were just as large this quarter, but I believe the final losses that they reported for the third quarter were probably understated. The point here is that we've had a rapid destabilization. We've gone from 22 weeks to 2 months, down to 2 months again between July and September, and then again 1 month between September and October. This type of destabilization is going to have an effect on the market. This is one of the reasons why I issued a crash warning for the next week. It's very important that you tell your friends this is not going to be a friendly market at all until the end of October. I can be reached at www.thepracticalinvestor.com. You may email me at tonyc@thepracticalinvestor.com. Please let your friends know about this. This is not something to be trifled with. There will be chances for recovery down the road. I hope to give more of these videos that will be educational and help you to understand the workings of the market. Now, thank you very much for your kind attention, and please do the right thing.